everybody. Welcome to this episode of Think Business. Looking forward to talking with Adam Coffey. Adam, it's great to connect with you, CEO of the Chairman Group and author of the Private Equity Playbook, the Exit Strategy Playbook, The Road to a Billion Empire Builder, and the second edition of Private Equity Playbook. And I know you have another book kind of at the publisher as we speak. Adam, it's good to see you. I appreciate you being on the show. And this is a topic that I really enjoy talking about. And before we kind of got before we pressed play today, one of the things you were sharing with me is that you work with 15 private equity firms, and so I want to talk about how companies, big, small, medium size, how they grow and how they scale in today's world. There's so many new factors today than there were 20 years ago. One being a very strong one being technology, zooming in really on AI too, and how companies are using AI to grow and to scale and to monetize their business, how to use it on all different levels. And so let's kind of start with the basics, with when is the right time to scale, when is the wrong time to scale.
So, John, it's good to see you. Hello to all your listeners out there. It's good to be back. I got to write books faster so we can catch up more.
Come back more often. Yeah.
There you go. Yeah. So hello to everybody out there. So listen, there's a lot going on in the world that you just, touched on. I mean, just in general, the economy has been a fairly volatile place since COVID. Been a lot going on there. High interest rates has really impacted growth in a lot of different companies. Inflation has been another big impactor. But, when I think of the world of private equity and I think of what's going on, it's like I just recently read, an article that McKinsey put out. And, the world of private equity just recently eclipsed the $7 trillion mark in assets under management. And I mean, the growth is phenomenal. If you go back 5 years to when I wrote the first edition of the Private Equity Playbook, doing research, for a book I wrote in 2018 with 2017 data. At that time, the world of private equity was about 2.83 trillion. If you go back 20 some odd years when I started my CEO career, working with private equity, then it was about 800 billion in assets under management. So in just about 25 years, we've gone from 800 billion to 7 trillion in assets under management. And so you mentioned AI. I'm happy to touch on that. When I look at the world of private equity, essentially what all these firms are doing is we've raised a fund. I've got a fund that's going to last for 10 years. I've got 6 years to deploy my fund's capital and go out and buy stuff and put the money to work. And so, they have this machine that's looking for deals. And they're using, what I would say lower level analyst type people to read hundreds and hundreds of books and look at all these hundreds and hundreds of different investments to decide where are they going to spend time and money digging in. And out of 300 books, maybe I'm going to dig in a little bit on 30. Maybe I'm going to buy one, company. And so the world of AI and the world of PE as an actual tool for PE, we're starting to look at tools that help us kind of look at these investment, the confidential information memorandums, the SIMs, the books, the prospectuses, to try to help us understand with some kind of automation, what companies might we be interested in without having to expend hundreds and hundreds, if not thousands and thousands of hours reading, looking, consuming. So seeing a lot of early efforts around using AI for that potential. But in terms of, you asked something else, when's the right time to think about scaling? I tell people, people that I work with, when I'm working with PE, I help private equity identify risk. So I do what's called operating partner work with them. They're financial investors. And they do a lot of research and have good understanding of industries where they invest. But at some level, they need operators who can dig into the companies themselves and say, here's the good, here's the bad, here's the ugly, run, or here's the risk, adjust your purchase price, accordingly. And so I'm doing operating partner style work. And oftentimes when I'm looking at companies, I'm looking at the fundamentals. And if I'm a business owner out there listening to you, when's the right time to scale? The right time to scale is when our business is working really well at the unit level, at the smallest level possible. And I can't tell you, John, how many entrepreneurs tell me, look, if I just get bigger, if I just add a bunch of revenue, somehow I'll find profitability, or somehow I'll figure out how to improve my margins. And I tell people that's the wrong answer. We need to make sure that our business works at the lowest common denominator. And if fundamentals are in order small, then it's time to scale. But if my fundamentals aren't strong small, I don't want to scale, because any problem or anomaly I have small is just going to get amplified bigger. And so it's better to attack it at what I call the unit level economics. So I'll just give you one example. What is unit level economics? Let's say I'm a landscape maintenance company and I want to build $1 billion landscape maintenance business and sell it to private equity and make a bunch of money and retire, or roll off in the sunset. Well, I need to focus on one truck, not 1,000 trucks. Can one truck with one 2-person crew with their lawnmowers and their blowers and weed whackers, can I bring in enough revenue at the unit level, one truck, to pass what I call as the 30-20-10 rule? I need at least 30% gross profit. I need my SG&A, or my back office and cost of customer acquisition, to be lower than 20%, because to be viable, any company needs to earn a dime on a dollar. And that's my first fundamental, application of a tool. And if your business isn't hitting that today, stop, don't scale, fix. And if I don't have 30% gross profit, I need to attack price. I need to raise the price for my goods or service. I need to lower my direct cost to create and service that revenue. That's where I dig in. If I'm over 30%, but I'm not earning a dime on a dollar, my SG&A is over 20, now I'm attacking back office. Now I'm attacking my cost of customer acquisition. So to me, a business is all about getting the fundamentals right small, and then scaling to success is a predetermined, economic formula that I can build. How much of the unit level economics do I need to get to the first $1 million of revenue? How much do I need to get to 10 million? How much do I need to get to 100 million? And I can reverse engineer success based on successful unit level economics. But if it doesn't work small, it won't work big.
I love that. 30-20-10. Let's talk about some of the fundamentals for a minute, because I love talking about fundamentals and getting to simple. When you are looking at these hundreds and hundreds of companies and to buy, what are some of the key fundamentals? One, I'm sure, is the 30-20-10, and where you can see the upside of maybe something that isn't there and how you can get it there. But what are some of the key fundamentals that you're looking at that make a true healthy business?
Yeah, so great question. And it's one that I think more and more entrepreneurs should be thinking about, because right now, for the next 10 years, we've got the largest transfer of wealth in human history going on, as millions of baby boomers are retiring and seeking to sell their businesses. What a great time to be a young person looking to buy your first business, with so many of them that are going to be sold over the next 10 years. But when I think about that question, and I think about the framework of what constitutes a good potential investment, I'll start by saying you can make money anywhere, in any industry. And some companies fare better than others in different kinds of economic cycles. So if I want to stack the deck in my favor and I want to increase my odds of success, then my framework is I start by looking for companies that focus on needs versus wants. So if I'm sitting inside my house or my office and it's raining outside and it's raining on my head, I need to fix my roof. I don't have a choice. It's not discretionary. I must do it. I'm going out to dinner Friday night because it's my wife's birthday. We're going to this great place in downtown Dallas. And she's like, I want a new outfit for our dinner. Okay, great, honey, go shop. But if I'm unemployed, if I'm hunkered down and trying to conserve money because I'm, the economy's rough or whatever, I can delay any spend I want if it's discretionary and based on wants. I can't I can delay a little bit, but I can't eliminate an expense if it's a need. So I think about needs versus wants. Then I think about project-based revenue versus recurring revenue. So why is it that software companies, in a, service as a if I think of SaaS companies and I think of software, why do they trade for such high multiples? Because they're recurrent revenue streams. Because once I've invested all the money in writing my code, it's nothing but pure revenue. It's very high margins. Think about pest control. Think about bookkeeping and accounting services. It's like, hey, I'm a small business owner in the Chairman Group. I generate millions a year in consulting revenue, but I have a bookkeeping service and I pay them $700 a month to crawl in my books and close them. I'm not an accountant. I don't play one on TV. That's a contract that once I sign, I forget about it. I live in a house. I'm here in Texas. I have, bugs in Texas you could put a saddle on and ride around the yard, and so you've got a pest control contract where they're coming and they're spraying around your house and doing different things, and they're hitting my credit card every month, and my accounting firm's billing me every month. Heck, just the janitorial service company that cleans my office, twice a week, they're hitting me up every month. It's like, think about companies like that. They could be professional services. They could be blue collar services, commercial, residential. But these are companies that are recurrent revenue. I sign a contract, and now when I do the hardest thing ever, which is go find a new client, it adds on top of the pile of clients I already have. And I'm hitting their credit cards every month, or I'm sending them an invoice every month and they're paying it. And now when I'm finding new clients, my revenue is building very quickly. In a project-based business, Adam gets a new roof today. He doesn't get a new roof next month because I only need one every 15 to 20 years. And so what's revenue today from me, they start back at zero next month, and they got to find a new me just to replace me. And so that's a project-based revenue company. It's a little bit harder, and revenue can be a little bit more volatile. So needs versus want, recurrent revenue versus project revenue. I then look for things like fragmented industries. So I talked about bookkeeping. There's 1.8 million small accounting, bookkeeping, payroll service companies in the United States. When there's high fragmentation, there aren't enough buyers to buy all the small companies, and that keeps my barrier to entry low. The multiples I pay will be low. There's 34 million small companies in the United States. There's only 3,000 companies on the planet that have $1 billion in revenue. So as I collect little companies, or as I grow my company and get bigger, I'm rewarded with multiple expansion. That multiple expansion yields shareholder return. If I'm a private equity firm, it yields personal return if I'm an entrepreneur building a business. And so I'm looking for highly fragmented industries, lots of small companies. I buy them, I collect them, I'm growing organically. I've got recurrent revenue, needs-based, not wants-based, and so you add all of this kind of stuff up, John, and we are just absolutely stacking the deck in favor of us as entrepreneurs out there becoming successful.
Love it. Let me ask you a question. Growing a company, I've grown some companies. I've sold a company. I grow companies as a business coach. Talk a little bit about, looking at the data and listening to your guts and not your ego when it comes to making that next decision and growing the business and scaling the business. Because sometimes the data can point to something, but the gut says otherwise.
So I like to see both of those be in alignment, and I think of a movie like Twister, and Bill Paxton is like on the side of the road with a handful of dirt, and he's, the sky's dark, and he's like, the tornadoes coming that way, right?
Yeah, great movie.
Yeah, that's my instinct. But I'm a data-driven guy. And so while I could bend statistics to tell me whatever I think the story is, I like to see both. I like to see the data supporting a conclusion that I'm drawing. Remember, I'm an engineer, so I'm data-driven. I'm anal retentive, strategic control freak. And so I like to see both. If data is unclear and I have to make some type of a decision, well, then I'm going to trust my gut. because I think over the decades, I've learned enough to have a pretty good set of, I'll call it gut instincts, about people. But I also want to tie that to some kind of data-driven metric whenever possible to say, but here's a slogan for a t-shirt. I'd rather, I rather regret not buying a company I should have bought versus buying one I shouldn't have. Meaning, if I'm going to err, I'm going to err on the conservative side. And if I've got some gut instinct that says, although the numbers are ticking and tying, and there's just something about this company I don't like, I'd rather run away and have missed a potential home run than have a problem child, and I got shiny penny syndrome and I overlooked it. And so, I'd rather not buy something I should have than buy something I shouldn't have.
Yeah. Let me ask you a question. I agree with all that. Thank you so much. Let me ask you a question. I forgot my question. Let me see if I can think of it. I had when you're building your book, The Road to a Billion Empire. I remember my question now. Okay, so it had to do with your book too. When your book, The Road to a Billion Empire. Today people are used to hearing, and a lot of times they're the outliers, the stories of, I started a business, I sold it 3 years later. I started a business, I sold it 12 months later. But how long does it take to grow? And I know there's not an exact answer to this, but how long does it take to grow a healthy business where a private equity company looks at it and says, okay, there's enough trailing numbers, there's this, but regardless if the private equity company wants to buy it or not, what is the lifeline of a healthy company?
So in my mind, my mathematic formula that I'm trying to solve for is 30% growth. If I'm a startup, and I go from $1 of revenue to $2, and I call that 100% growth. That's the fantasy land of VC and startups.
Yeah,
real companies with a track record of history and earnings. And a mature business. Let's just play some math numbers real quick. If I have a company with $1 million in revenue and I'm growing at 10% a year, I can invoke the law of 72 in investing. It's going to take 7.2 years for that company to double in size, which means in 7 years, $1 million becomes 2 million. And in 14 years, 2 million has become 4 million. And in 21 years, 4 million's become 8 million. I'm 60. I'm now 81 with a walker and a drool bucket, and I got to 8 million. And if that company has 15% EBITDA margin, I'm just over $1 million in EBITDA. It's a pretty disappointing exit compared to if I'm growing at 30+% a year. If I'm growing my earnings at 30% a year. Every company I've run was in business for 40 years before I got there. Once I got there, I was able to stimulate it to grow organically, to improve margins, and use mergers and acquisitions, buy and build as kind of my secret sauce ingredient to go from mid-teens, what was disappointing in low single digits, to now growing in the teens between organic growth and margin improvement, and then sprinkling some M&A on top of that to get it up to 30. And so at a 30% growth rate, a company doubles in size in 2.8 years, and it triples in size in 4.2. And it doubles in size in 2.8, triples in size in 4.2, and it quadruples in just over 5, which is the typical private equity hold period. And so that same $1 million company in that same 20-year period, growing at 30% a year, gets to 190 million in revenue, not 8. And it also now a 15% EBITDA margin. It's got about 25 million in EBITDA. And it now, depending on industry, may be selling for 400 million. Do I want, if I've got a little over $1 million, selling it 5 times for 5 million, or I'm selling 25 million, and I'm depending on industry, I'm selling it for 10 times 250. It's like, which exit excites you more? If we want, to not die with a small business, we're going to need to grow at a sustained rate of about 30%.
Yeah, I love it. This was great. Adam, quick speed round. You ready?
Sure.
All right. A book since we last spoke that has had a big impact on you.
Other than my own, wow. I'm a classics guy. Something I did recently, John. I do a lot of books on tape, and
Yeah.
I periodically go back and reread things. And so Jim Collins' Good to Great was one I just recently did. I did The Millionaire Next Door again just recently. It's like I'm doing some of the classics rather than some of the new stuff. And
I do that too sometimes. It's almost like
fundamentals. So for me, it goes back to fundamentals. What
Yeah.
are the fundamentals of investing? And what are the fundamentals of what I'm trying to accomplish, what I'm trying to build? To be fair and honest, though, I'm spending so much time lately writing stuff that it's I'm not doing as much business book reading on contemporary stuff as I'd like to. I just got asked. There's a second edition of a private equity book that's coming out that I did not write. I just got asked to write a guest chapter for it, so I was working on that too. So I would tell you that books. Here's the comment: we should never be complacent. We should never stop learning. As entrepreneurs, no matter how successful we are, we need to continue to have a thirst for learning new tricks, learning new things, investing in ourselves, and never think you've arrived. You're at a place and you want to get better. It's continuous improvement, just like when we're running a company. And so always be learning new things.
That is, spot on. Best piece of wisdom you've ever received?
Once a president, always a president. I was at GE at one of those crossroads in life. Do I stay rising talent in the world's biggest company with the world's most admired CEO, or do I leave to go be a CEO of a smaller company for the first time for this thing called private equity that frankly back then nobody knew what the hell it was? And my mentor within GE was an ex-Cleveland Browns football player. And I remember I took this question to him, do I stay as a general manager, at GE, one of 1,000, or do I take a stab and go be a president? He looked me up and down. He said, Adam, once a president, always a president. Get the hell out of here. Go be a president. The world will never see you as anything other than a president again. Best advice I ever got. And so what was the advice? Don't be afraid to take a calculated risk when you're betting on yourself.
I talk about that a lot. The best investment is in yourself. Finish your sentence, Adam. One thing everybody should do that if they want to start writing a book, you've written many, but some people will share with me they've got a book inside of them that they haven't started. So one first step that everybody who's got a book they want to write should do is?
So create an outline. So let's create an outline. The basic business book today in today's business world is 40 to 50,000 words. There are 12 chapters, 4 sections, 3 chapters for each section, an introduction, a conclusion, an entry into each section, an exit into each section. It's like if I lay out that framework, now think about where is my expertise? What is the value that I can bring to the person that's going to read this or hear it as an audiobook? And I start by filling out a 1-page outline that's basically on that. If you take all my books, 12 to 13 chapters, 4 sections, 3 to 4 chapters per section, intro, exit. That's a business book today. So I think about Empire Builder, it's like, what were the sections going to be? What were the titles of each chapter going to be? And then I go from that 1 to 2 page outline to like an 8-page outline. What are the 3 key points I'm going to make in each chapter? And so 3 chapters of the first section is 12, or is 9 key points. 4 chapters is 12. It's like, what are those key points? And it's like, before you know it, I've got like a 20-page outline, and the book is now almost written itself. And structurally, I can move it around. So to me, it starts with that kind of a framework. It's going to be 40 to 50,000 words. It can be read in 5 hours or less. It's going to be a couple hundred pages. It's going to have 12 chapters, 4 sections, 3 chapters per section. Think of it along those lines, and it makes writing that book just really easy. It goes from being an exercise in world hunger to now I'm writing a book report.
Yeah, I love it. I followed a similar format when I wrote mine, and so I love listening and doing things in some type of.
And all of my books started as lectures.
Yeah.
So Empire Builder, I taught a 2-day seminar. It was a 350 PowerPoint slide deck that I created a 2-day seminar. And then after the seminar was over, I went back and took that seminar, used my outline format and wrote the book Empire Builder.
It's great. Adam, I appreciate you being on the show again. It's always great connecting with you. Think Community. Adam talks about a lot of stuff. I'm a business coach. I work with people who are successful, stuck. I get them unstuck. And I love this show because I get to have guests like you, Adam, who share information to help people get unstuck. Just to extract a couple key things that you said. One way to get unstuck, Think Community, is to be looking at your business, the 30-20-10 rule that Adam talked about. It's so important. Numbers don't lie. The data points are so important as you grow and as you scale, and use those data points to make really smart decisions. Needs versus wants, which I think is so important and a difficult question a lot of times for people to make that decision. And lastly, although you said many things, the alignment of data and gut. And once a president, always a president. Typically, that type of person, like you, like me, moves a lot on intuition and gut along with the data. But I agree with you, they need to be in alignment. Well said, well said. Adam, tell people where they can buy your books, the Private Equity Playbook, Exit Strategy Book, Empire Builder, and Private Equity Playbook, second edition, and how they can connect with you.
Yeah, sure. So I'm on Twitter, Instagram, LinkedIn, but I spend most of my time on LinkedIn. There's 830 million business people on LinkedIn. Probably 30 million of them are fake. But, aside from that, it's like I answer all my own social media inquiries. So reach out to me on LinkedIn. My books are available anywhere books are sold, Amazon, Borders, wherever you go. There's audio books, Kindle or ebook versions, and print and hardcovers. So, and I donate 100% of my royalties to go to charity. It's getting harder to give the money away each year because my sales have been increasing. So I appreciate the support that I've got out there. But that's it. That's where you find me. LinkedIn, you get me. There's no team of people in my social media. It's me.
It's great. Adam, I appreciate it. I appreciate your time, your insights. I appreciate you taking all your information. Your books are great. I love them. I own them. I have them on Audible so I can read them and listen to them. You have a great way of just breaking things down in really great formulas like you did on today's show. Think Community, check them out if it's something that you're interested in. And if you want to talk about any business coaching, you can reach me at johndwoskin.com. Adam, this was great. Thanks a ton.
Thanks, John.